I think sadly we're in crypto winter. I don't think we're going to make new all-time highs this year. I hate to say that out loud, but I just don't think it's going to happen. I think the next cycle is going to be glorious, and I think we'll hit 400 or 500K in 28, 29. So the glory days are to come, but I think the short term is going to be tough. And the surprise 11 was on precious metals, and I said that the debasement trade that everybody thinks is going to happen. It's long in the tooth. We're probably closer to the end than the beginning, so we'll see how that goes. When you take time, I would say not just to think out of the box, but to think like there is no box. So if you can start from first principles and just don't worry about what everyone else, and just think like based on the data, how would I interpret it?
Yusko begins with a reflection on portfolio structure and the importance of diversification across uncorrelated themes. He notes that an equal weight portfolio spread across 11 major asset categories, roughly 9% allocated to each, produced a return of over 30%, even though many individual calls were wrong. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
If you built a portfolio, equal weight, right? Just 9% in each of the 11 areas. The market was up 18%, okay? The portfolio was up 31. It's actually pretty good. Even though we're only 6 and 5, so not right very much more than we were wrong. And when we were wrong, we lost a bunch of money, right? Because we thought the market would go down. Again, the surprise was the market was going to go down, but it didn't. It went up 18%. So being short the market, you lose 18%. But even with that, like we had gold going to $3,000, which back a year ago was really outlandish. It made $3,000 by April and then, went up a lot. So we made a lot on that surprise. This year, we always start with big picture economy. And again, for I think like the 6th year in a row, everyone's sure there'll be no recession. Recessions have been outlawed, no more recessions. So the surprise this year would be there actually is a recession. Polymarket says the odds are, sub 15%. So that's probably right. But that would be a big surprise if it comes out of the blue. Now, what I said is the overall economy doesn't look like it's going in recession. But there is this K-shaped economy problem. The people at the top, they feel good. If you're at the bottom, you've been in recession for a few years. And it's tough living paycheck to paycheck. And the bottom half of the US, they don't own stocks, they don't own real estate. So I will argue we've been in a recession for a while. We just don't count it because the billionaire class gets to make the rules. So that's what. Second was on interest rates. So everyone, was convinced that the Fed was going to cut rates. I think not so much. Why would you cut rates if growth really is 5%? So that'll be another surprise. If things surprise to the upside on the economy, you're unlikely to get rate cuts. And so that, now the one piece of that is interesting is the QE, although we can't call it QE, but it is QE, is restarting. The Fed balance sheet is going back up. And this thing that we just did last night with the bailing out of the yen, that was not on anybody's bingo card. So that means money supply is going to keep growing fast. That's really good. And you've seen it in gold and silver. Now, Bitcoin hasn't caught up yet. So then third surprise was about general markets. Everyone thinks the market's going to go up 12%. They think it's going up 12% every single year. Like if you look at 10, every year, they think it's going up 12%. It never does. It's actually never in 140 years gone up exactly 12%. A little more, a little less, or a lot more, a lot less. So the surprise would be that we actually have a bear market. And the bear is not going to be happy till he's going Mach 2 with his hair on fire. So we'll see what happens. Number 3 was that the Mag 7, which everybody loves, suddenly becomes kind of the Lag 7. And, I actually think that one's probably baked in because there's a lot of people who are starting to favor small caps. Surprise 5 was about oil. Look, oil, we all know what the president wants. The president wants low oil prices because there's an inverse relationship between presidential popularity and the price of gasoline. He said, I want sub $2 gasoline by the midterms. We'll see if he gets that. Right now, supply is in excess of demand, and so we're headed lower. But the surprise would be that oil prices firm and Saudi gets what they want, which is higher prices. 6 was on the dollar. Again, everybody this year thinks the dollar was going to reverse and recover. No way. In fact, we're collapsing, partly because of this intervention. So I think the dollar is going to have another year in the toilet. Surprise number 7 was about Europe. And, again, after last year, it was, oh, Europe's great. Like, no, Europe's not great. There's no growth. The economy is moribund. There's no tech. They have no trillion-dollar companies. What's great about it? So I think now that everybody's jumped on the bandwagon that Europe's going to go up, I think it probably doesn't. 8 was Japan. Japan's super easy. Since 2011, Japan is super easy. If the yen goes down, Japanese equities go up. And unfortunately, and I think we're seeing it this week, the yen is on its way to zero, like literally going to zero because they have no way out. But governments aren't going to allow that right away. So in order to save equities, you need the yen carry trade to stay alive. And so I think the US just bailed out the yen. So the yen went from 160 to 154. And I think that means, Japanese equities could turn into, from the land of the rising sun to goodness gracious, great balls of fire. So I think Japanese equities will get torched if they let the yen strengthen. Surprise 9 was about China. Everybody hates China. I mean, everybody hates China. I love China. I've been a China-phile since 1994. I love China. And it's been one of the best performing markets. And not every year and not every sector, but man, if you invest in China for local Chinese growth, it's unbelievable. So I think that will outperform. And what people don't understand is the US and Trump in particular they're arguing about how you set up the checkerboard. China's playing Go. It's a totally different game. Checkers and chess are all about confrontation, right? Go is about relative advantage. And they're playing a game that we don't even know we're losing. And they're crushing us in things like 5G and AI and dominance in technology, chip production. So really good stuff. 10 was about Bitcoin. I think sadly we're in crypto winter. I don't think we're going to make new all-time highs this year. I hate to say that out loud, but I just don't think it's going to happen. I think the next cycle is going to be glorious, and I think we'll hit 400 or 500K in 28, 29. So the glory days are to come, but I think the short term is going to be tough. And then surprise 11 was on precious metals, and I said that look, the debasement trade that everybody thinks is going to happen, it's long in the tooth. We're probably closer to the end than the beginning. So we'll see how that goes. When you take time, I would say not just to think out of the box, but to think like there is no box. So if you can start from first principles and just don't worry about what everyone else, and just think like based on the data, how would I interpret it?
On Bitcoin, Yusko strikes a cautious near-term tone. He believes the market is in a crypto winter and is unlikely to reach new all-time highs in the immediate future. This is not a rejection of Bitcoin's thesis, but an acknowledgement of cyclical reality. Looking further ahead, however, his outlook is dramatically different. Yusko expects the next cycle to be glorious, with Bitcoin potentially reaching several $100,000 later in the decade. The short-term pain, in his view, is the cost of admission for long-term participation in a monetary transformation.
If you think about this AI, A and B, and it's a great point, John, we love A, B, C, D. But what we really love is A and B, or B and C, or D and A, or like A, B, D. Like if you can get 3 or even 4, nirvana. So the more intersections, like that Venn diagram, it's like the Ikigai, right? You have the 4 things, and in the middle is the Ikigai. That's the secret sauce, if you can get all 4. So that's a Japanese term for your purpose in life, right?
I read the book. I'm familiar, yeah.
Yeah. But I mean, so we actually coined a term, believe it or not, and actually tried to service market, and it cost too much money, so we didn't do it, but called blockchain intelligence. Back in 2022, we were raising our 3rd fund, and our first 2 funds in 2018 and 2020 were really about, because I'm a financial services guy. I'm not a tech guy. I'm not an engineer. I don't even play one on TV, right? I'm an old school financial services. I was an allocator. I was a macro guy. In fact, I'm one of the OMGs of of blockchain, right? The old macro guys. So it's myself and John Burbank and Dan Moorhead and Dan Tapiero and Mike Novogratz. I mean, there's a whole bunch of old macro guys. Now, why did old, keyword, macro guys suddenly see this as an opportunity? Well, it's because it's just the biggest macro trade in the history of mankind. We're reinventing money. So, but in 2018 and 20, we were all about the picks and shovels of the digital gold rush. So I actually wrote a long paper about this, like 40 plus pages back in 2017, about how in the gold rush, right, the gold miners did not get rich. I mean, a couple of them did, but by and large, they all lost a lot of money and a lot of lives. The guy who got super rich, the first millionaire in California, was John Banham. And he was the owner of the general store in Yerba Buena. It wasn't even called San Francisco back then. And he literally bought every pot and pan and went down banging the pots and pans in the middle of the street saying there's gold in the American River. And, you know, he got super rich selling, believe it, $6 eggs in 1849. Do that in your inflation adjustment thing. And we complained about eggs a year ago. Now eggs are super cheap again. But the thing is, in 2018, 2020, everything we did was about what blockchains were going to do to financial services. Because what the internet did to media and commerce, total disruption, created $7 trillion of value that it basically extracted. Netflix versus ABC, NBC, CBS is the best example. ABC, NBC, CBS had all the market cap. They had all the content. And then suddenly Netflix took all their market cap and started creating content. How? How did they, ABC, NBC, CBS, the incumbents, cede power to this little upstart Netflix that almost went bankrupt twice? The first time because they were shipping discs, which is a really bad business model because they break or get lost. Then they tried video on demand, but video took 4 days to download and no one's going to wait 4 days. So they almost went bankrupt twice, but broadband came along and suddenly they got people to sign up for subscriptions. And ABC, NBC, CBS were, no, we're ad-based revenue. We're not going to go to subscription because our stock price would fall. Well, your stock price fell anyway, and now all your market cap's gone. So I don't really understand it, but they didn't do it. So that transition of what the internet did to media companies and commerce, all the mom and pop went to Amazon, is what's happening now with financial services. And financial services is by far the largest industry in the world. Like, it's orders of magnitude bigger than commerce. It's orders of magnitude bigger than media. It is by far the biggest. It's $7 trillion with a T dollars a year of fees so that we can give our money to these centralized authorities. Then now it becomes their money. Like, this is a dirty little secret, right? You put your money in the bank, it's no longer yours. It's now the bank's. And you have an IOU, and it works most of the time, but when it doesn't, it's bad. Same thing with brokerage firms. We have accountants and auditors and all these people counting the money. But why? We have a better technology now. So that transition we thought was going to be monstrous. So our first two funds were focused on that, and they've done nicely, very well, actually. Humble brag. But we got that timing right, in that financial services companies like Figure Technologies and Coinbase and eToro were going to evolve into these market leaders. But in 2022, we saw this integration, as you say, between the A and the B, and the AI tools, right, which were still pretty rudimentary. This is pre-LLMs, were helping us make blockchains more efficient, more intelligent. And so we coined this term blockchain intelligence. Now, it didn't do us a hill of bean of goods because nobody understood what we were talking about. But it did help us make a couple really nice investments in Fund 3 and Fund 4, which I think are going to do amazing things. But, you know, this idea that you should only own, you know, the LLM companies just makes no sense to me, in the sense that is a tool. And the best example is what Anthropic is doing to ChatGPT, right? OpenAI. So OpenAI had 85% market share 3.5 years ago, 85. Now they're down to 25. And Anthropic has 32. and Google is at 18. And Google's going to win it all because they manufacture their own chips, the TPUs, the tensor processing units. And if you're OpenAI, you got to buy chips from NVIDIA with money you don't have, which is going to be a problem. But anyway, again, long answer to your important question, which is the intersection of the things. And AI and blockchain, we think, are one of the most important because data organized on blockchains, it's just it's a ledger. It's a general ledger system.
Yusko draws a direct parallel between blockchain's impact on finance and the internet's disruption of media and commerce. Just as Netflix and Amazon dismantled entrenched incumbents, blockchain threatens to disintermediate financial institutions that extract trillions of dollars in fees. The key insight is not digital gold alone, but the picks and shovels of the digital gold rush, the infrastructure, platforms, and tools that enable decentralized systems to function.